Welcome to Principal Protection Startup Funding, presented by Echelon Ventures. We're going to walk you through this entire program to get a basic understanding as to how this structure can protect principal investment 100% for any startup venture or any other risky venture that is lacking collateral, and will put the investor and the startup principals at ease when getting money injected into their business. So let's get started. Presentation, basically we're going to talk a little bit about the company, what we're dealing with in the current landscape of funding, different choices, and then we'll move into our solutions and into the details of that. So a little bit about Echelon Ventures. Our philosophy is to provide experience of discovery, and we operate in the areas of tech and finance today, contemporary areas. I'm the founder, James DeSico. I'm an entrepreneur and an author in these spaces, and also am running the El Segundo-based Beach Coders Academy. A little bit about that. We're teaching contemporary skills in tech, which is HTML and whatnot. It's a basic coding academy, again, to connect with the startup community, being in the coding space and the talent space. Beachcoders.com to check out more about that. Okay, so let's get into it. The current funding landscape. Right now, it's a really basic diagram where you basically have an offer for you put out an offering to raise funds for your venture. You negotiate the deal terms. Usually that's, we put the gears there because you're kind of getting grinded out about how much equity you have to give and all these types of things. And then you get the funding. Now comes the payback time. Now you're kind of starting the clock, and you've got what they call a runway or a burn ramp or a burn schedule, and the heat is on. So the problems with these types of models, no matter where these are different sources that would follow that pathway. You've got bank loans, you've got private investors, you've got crowdfunding, you've got venture capital, and of course self-funded. And as you can see, if you can't read the details there, you can see that all those bubbles basically lead to pain. The bank loans are very difficult to get, and they come at a big cost, and they're very time consuming. Private investors, again, are usually structuring things very leaning heavily towards themselves, and can actually cause more problems in many instances than they solve. Crowdfunding, while it was very popular at one point, it seems to be waning. It's a very difficult thing to get traction, which is what you don't read about so much. You see a couple of success stories, kind of like lottery winners. But at the same time, if you think about managing one or two private investors, imagine trying to manage hundreds or dozens or hundreds. It's really a task by itself. Venture capital, same thing as private investors. You're dealing with this type of a lopsided equity position to where they're in control and you're kind of working for them. Self-funded is a great way to go, except if you don't have the money, that's not so great. And then furthermore, if you do have the money, the risk that you're putting upon yourself if there's failure is tremendous. And so all those really have a high potential to lead to pain, all driven by your passion to get your startup off the ground or your project. So we asked the question, what if there was another way? We use the Principal Protection Program from Echelon Ventures. It's very simple to structure. We can create leverage inside the program. It removes the payback anxiety piece altogether, and it also provides a very significant and robust personal protection beyond corporate protection, corporate veil, anything like that. So our process is a little different now. We have the deal structure. Once we put that into place, we're able to add leverage and then create the liquidity for the funding, and then we provide a little bit of guidance moving forward to make sure that we're sustainable into the future. We're not necessarily guiding your business, but we're guiding you as far as maintaining the structure, and it's a very easy and ancillary sort of advisory level guidance. The relationship diagram, very simple. As you see, we're not getting in the middle between the investor and the project. We are guiding both sides. The investor and the project remain directly in contact, and whatever deal points that they come to an agree upon, whatever you would come to an agreement on, will stay in place. We're just there to guide both sides and serve and add value to both sides. So the cost, we love this slide. It's absolutely no cost up front. There's no back-end cost per se. We don't have engagement fees. We don't have retainers. Our fees are basically, the way we make money is directly by the financial products themselves, in which we have incorporated into this proprietary structure. And so what you won't see is, you get whatever amount of money and then you owe the funding company a certain amount. That doesn't happen here. There's no back-end costs. There's no front-end costs. So it is essentially zero, which is a very, very attractive piece. Okay, how do we do it? We incorporate a thing called indexed universal life. It's designed specifically for this environment, the way we've structured it. A+ or better rated providers. These are nameplate providers that you've certainly heard of. It's safer than the banks. It's true, because the rating is higher, and all of these insurance providers, carriers, have a higher reserve, usually 3 to 4 times the reserve that's even mandated for the banks. We have predictability, no matter what's going on in the financial markets, which that alone is an outstanding piece. We also can create leverage, and the capital risk is near to zero. We always have to say near to zero for any type of unforeseen thing, but put it this way: in the financial collapse of 2008, these providers barely even showed a wrinkle. So if that's any indicator that these things are very, very robust and very sustainable. And inside this structure, it's even more exciting because you can put them to work for you. Okay, applications. Of course, they're for startups, but they're also for risky entertainment ventures or purchases. Maybe just to buy real estate. In general, you can use them to build assets in general, because as you create this structure, you're creating an asset, and it can provide, if structured properly, can provide a lifetime of income inside the structure. So let's take a look at what typically happens. We call this the risky plan, just like going to Vegas. You basically have an entity for your private offering, and then you put that out, you promote it to the investors, and then in the pill bubble, you see the subscribers sign on and remit the funds on a capital call. What that means is that investors say, okay, I'm going to contribute X amount of funds, and that money, a check gets written right into the company. And basically, that's where the risk really comes in, because that money's gone from the investors, and hopefully they're relying on the operators of the venture to come through. And even with the best intentions, things might not work out, and they're going to lose the money. So we have a better plan. So remember that top line. Our plan is a safe, hedged plan where you can see we still have that same top line, but coming from the subscribers, the third bubble out, you see that it doesn't go straight into the offering, but all this bottom piece we have, we set up an irrevocable life insurance trust. We name a beneficiary. We have a bank account that's set up in the name of that trust. The insurance provider that we're using will create and activate what they call an in-force policy, which is activating the policy. And then we have a bank that will loan against those policies. We have an escrow to hold funds, and the money that is created in this process will get dispersed via the trustee into the offering activity. Now, why is this better? Because there's a control on the way the funds move, and there's zero risk because the money goes into the policy and is managed by the trustee, and everybody's under supreme fiduciary duty, which means everybody has, they've got to follow all the rules. They've got to mind the P's and Q's on the money and make sure that everything is done correctly. But the good news is that all that complicated process down there is what we do. We handle that. We've got the legal, we've got the accounting, we've got all the turnkey pieces for setting up those entities and the trust and the beneficiary. We've got it all, and we're not charging anything for it really on any of that. It's built into our cost of operations, and we are remunerated directly, as we indicated before. And so basically, you're now offering to your investors a way to secure their funds and get the money into your venture without putting them at risk whatsoever. they're going to see from day one exactly when they're going to get 100% of their principal return and any type of interest that you might have built into that, so that you can say, look, in today's world, when we're making this video, you're looking at about 1% return on a 10-year CD with a significant contribution of 100,000 or more. In this plan, we can offer significantly higher returns than that in a even safer environment than a bank CD, because again, these companies have 3 to 4 times the reserve requirements, and they're A+ rating or better. And so that money is going to be there in any type of economic environment. And so that's the beauty of this plan, is that we handle all that for you. It's a turnkey process. So we take a sample illustration here, and we want to break this down as simple as possible. But basically, we're loading up the premium on the front end for this policy for a 45-year-old person that's an entrepreneur, and we're able to pull out $100,000 right at the beginning to create liquidity for the project. And then across from year 5 onward, you can see a $26,000 cash draw happening sequentially year after year after year until all of that premium is paid back. And here's the good news, folks. That $26,000 cash draw from this one-time contribution on the front end goes on in perpetuity. It goes on for the remainder of that person's lifetime. They'll be able to draw that down every year, tax-free for the rest of their life. And this is through a key man structure that we've put together, integrated into that system that we showed you in the previous slide. So basically, depending on the capital requirements of the project, this whole chart and everything is going to be even higher. We've seen structures where a capital requirement is upwards of under $1 million, around $500,000, and then we're seeing cash draws in somebody's senior years at the early part of their retirement age. They got their money for their project, but then later on they're able to draw $1 million a year tax-free for the rest of their life. So if you think about that by itself, that's kind of like having a successful business anyway. If you think you're doing this, that you're passionate about this, and it's a great way to make money and live your passion, that's great. You can live your passion. And whether the business takes off or not, this structure will be there for you, and you'll be able to take money forever, for the rest of your life, tax-free. And that's what's so exciting about these structures. So, Echelon Ventures. Go to echelon-services.com, info@echelon-services.com. Call us directly, 213-375-4753, and discuss your project with us. We'd be happy to go over the details and get you started on how you can take this process and implement it into your existing fundraising activities, and get together and present this with your investors and how to secure their investment and secure everything. It's a far, far superior way to go. We look forward to hearing from you, and thanks for watching.